Today we're going to be going through the Hindenburg research report, and I really am basically just going to be refuting a lot of it. After this report came out, just full disclosure, I did build a position in Sezzle, so obviously I have a vested interest in this business succeeding now. Before I start though, I think it's best to just cover what a buy now pay later business basically is. So buy now pay later is actually what it sounds like. You can buy an item up front and then you pay the price of the item over the course of usually 6 weeks. So usually at pay in 4, so you pay 25% up front and then you pay the remainder payments every 2 weeks. So Sezzle is one of these businesses. Probably the most well-known businesses in this field is Affirm and Klarna are some of the really well-known ones. Now, before I go into this, there's important context to understand about Sezzle. Sezzle was on the path to bankruptcy within the last 2 years. In 2013, they actually had pretty good earnings if you go back and look, but it was not a good place for the business. They had run out of cash. I don't think they could have easily raised money. And then they also have this weird thing where they had listed on the Australian Stock Exchange, and then they delisted from there and then listed on the NASDAQ. And the reason why they said that they had originally listed on the Australian Stock Exchange is they thought that they'd be able to raise more money. They thought Australians understood the business better. And it's also possible it was easier to list on the stock exchange, maybe less standards. And it's also possible that they didn't want it to compete with Affirm when they were originally listing and raising money. But they did delist from that exchange, and then they did relist on the NASDAQ. So that's just some important context about this business. So let's see. I guess we'll just go through all of these points. I think it's the simplest way to kind of go through all of this. So the first thing that I'll start with is this premium. Anyone who's worth their salt in terms of investor does not use price to sales as a serious metric. If you look at CVS, their price to sales is less than 1, but do you know anyone bullish about the business of CVS? In the case of Sezzle, they're actually the only profitable buy now pay later that I know of. And a lot of the other businesses that they compare them to that have a bad price to sales ratio, it's because those businesses are not profitable and they're not growing. So this is just basically a completely irrelevant metric. Really what matters is profitability. And right now, Sezzle is trading at 25 times earnings, and they're trading at forward earnings of sub 20 after this short report. And it's important to note that they grew 70% year over year last quarter, and I think they're going to have 50-60% growth for this year. In terms of revenue, and their earnings growth is much higher. It's 1,000% or something. So for a business that's growing 70%, or 50-60% year over year, 25 times earnings is ridiculously cheap. So just to be clear, Sezzle's not trading at a premium. It's trading at a very significant discount relative to what the business is actually doing right now. In terms of expensive capital, when you do the buy now pay later, you do rent or loan out money essentially, right? But if you're going to do this with a line of credit, you're not actually collateralizing this with anything. So any bank that would let you do this is going to say, hey, 2 things. First of all, you're not lending this out to people to buy a house or something, right? They're lending to buy items, so you cannot recoup a loan that goes into default. You lose everything. The second thing is it's a short-term loan, so it makes sense for the loan to be 12% interest, for this to even be worth a bank's time. So that's what I point out. These loans, I would argue, are not risky. So what comes from risk is not, the income level of the borrower or even necessarily the credit score. It's just basically on the standards that you're setting when you go to make the loans. So you can lend to any earning demographic responsibly, right? And if you go look at Sezzle and what they estimate for basically their charge-offs for loans that go default, they've been very good about those charge-offs. So again, I guess you could say risky is subjective, but based on how their business has gone this year, the fact they're very profitable, it's hard to call their loans extremely risky if people are paying their loans back. And if they weren't paying their loans back, they would be having a lot of profitability this year, just so people are clear. This is such a nothing statement, in my opinion. I actually think it's a good thing. It means the CEO doesn't want to sell his shares, and he'd rather hold on to them because he probably believes in the business and the long-term growth of the business. From his perspective, this is actually much riskier. But this is something that you might want to do if you either don't want to sell ownership of your business. And it's actually crazy he owns 30% of the company. That's a lot of ownership for a CEO. Most don't own this that much by the time they go public because of the amount of dilution they do to raise money. This is another nothing statement. An insider left the company and he sold all of his stock, and he actually sold it for like less than half of what it is today. So if he had held on to it, he would have basically made 2 or 3 times this amount of money. So I kind of imagine that has to hurt. As we mentioned, they were in Australia and then they delisted. Despite its collapse in Australia, Sezzle was able to report profitably, probably from reporting significantly lower provisions for bad loans. So the reason this started to happen is they started to have better standards for their borrowers. So that's why they started reporting bad provisions for bad loans. And if they were misreporting these, they would show up as losses. This is like one thing I can't emphasize enough. As we said, it's 6 weeks, to have these paid back, right? It's a very short time period. So you would see it by the next quarter if these loans were actually risky and bad, right? They would have shown up by now. This is not a high interest rate at all relative to the kind of lending they're doing, right? Short-term lending to stuff that's not collateralized will always have a 12% interest rate basically. So if you go get a loan, even if you make a lot of money, okay, if you try and get a short-term loan that has no collateral, you're gonna pay over 10% interest. Again, to talk about how they issue lower quality loans, and as I mentioned multiple times, we'd be seeing a lot of losses. So, and I also find this interesting where they talk about how their loan book just grew 6% over year, but provision for credit losses increased significantly. Sezzle doesn't actually really have a loan book because they don't earn interest on the loans they give out. The way these buy now pay later businesses make money is through commissions usually. So the merchant pays commissions like 6% of sales. But Sezzle also makes money off of subscription services. So Sezzle's kind of niche that they have found in the market is they allow their users to pay subscription to use buy now pay later anywhere. So you could use this if you wanted to, theoretically, anywhere except Visa. So you could like use it to pay rent if they accept Visa, or you could use it to pay for Costco food or whatever. So I wouldn't even really call this a loan book. And the other thing I point out is their business model has gone away from maximizing, the sales, because now they have the subscription revenue and they have commissions from merchants. So they have a bit of both, which is actually, I think subscription, in my opinion, is actually a much stronger revenue model because it's more predictable. I find this one kind of funny because buy now pay later is a very new business in the last 6 years. So there's going to be really nobody who has experience in risk in terms of buy now pay later. The best you could get is within the credit card industry, and honestly, the best people typically you could get would be like someone at Capital One. So like this is just basically like, oh, we found he doesn't have an experience in risk, but if you go look at the way the business is performing, he must be pretty good at it because they're not writing huge amounts of losses. Merchants are abandoning Sezzle. So this is not actually true. Sezzle's been cutting off a lot of merchants. And the reason why is a lot of these merchants were not actually making Sezzle money, because what people would do is they go to a merchant and they'd buy a product, and the product would not get sent to the user. So they would literally lose money because if I buy something and I don't get it, I'm not gonna pay you back for the pay in full, right? I didn't get my product. So they basically started cutting off all the merchants that they didn't make profit. And that's why they had the subscription model, which allowed you to use any merchant with the credit card. Well, it's not a credit card, like it is a virtual credit card that they issue. That's why they shift away from this business model. So maximizing merchants is not as good as it sounds, right? Because you can get a lot of merchants who will actually just cost you money. It's true that they have lost out, like on Target and all these big businesses. They are not the winners in this area. That's a firm, or maybe Klarna. So that's what I've kind of mentioned here. Sezzle's have found a niche. We'll see how it evolves. Now you might be wondering, like, where are people using this, right? If it's not like Target and Walmart. A lot of it's hobbies. So it's these very niche, like hobby stores that can be very expensive. If you're really into like bikes or something, or you're into drones. Another one I saw online, which I found was interesting. People who are really into buying guns. Guns are pretty expensive. It's gonna be over $1,000, and these gun stores don't partner with anyone. And I would guess part of that is 6% on $1,000 is $60. So I think it's probably worth it for Target to buy now pay later, but maybe not some of these bigger businesses. So again, like another nothing statement here. Sezzle also seen this is actually true. Now what I find interesting is they don't mention this, but Sezzle actually had customer growth for the first time last quarter, and that's because they started reinvesting pretty heavily in advertising. And they lost customers because they started focusing mostly on the small demographic of active customers, the ones who do this subscription, to use buy now, pay later anywhere. And then these customers actually turned the business around. So they inverted the business model, and it's been very successful for them. So like again, this is a bear case for the business, but does not actually say anything about is this business doing things they should not be doing. With sketchy enrollment practices, I'm not going to go down and look at this, but I just kind of want to point this out. Every business that exists, it's not hard to find negative reviews. Every company in the world. And one thing I actually find funny about this is they kind of mention Trustpilot. And if we go look at Trustpilot here, and you go look, Klarna's rated pretty well. Let's look at Affirm. PayPal is not rated well, who also do buy now, pay later. Affirm's actually at 3 stars, and then you look at Sezzle, and at 4.2 stars. So people who use Sezzle clearly enjoy using the product. I don't even know what this is. I've never heard of Better Business Bureau. Again, I don't think it's hard to find bad ratings about any company or to make any company look bad. I'm sure if we look at enough websites, we'll find someone where Sezzle's rated poorly. Been left in the dust. It's interesting that they mention this because when they're comparing Sezzle's price to sales ratio, they compare them to like a bunch of other random buy now, pay later businesses, but it's literally none of these except Affirm, and Affirm trades at a more expensive ratio despite not being profitable. In terms of being left in the dust, I think there's some truth here. Affirm has grown very well. I think Klarna has grown very well. I have no idea about Afterpay. So like Sezzle kind of lost the overall race to buy now, pay later, but they pivoted and they still provide this service, but like I said, it's more niche than what they're offering. Now, I don't know if Sezzle is going to succeed long term. I don't know what the ceiling of this business is, but I do know that it's working. Okay, if we actually go and look here, actually I just by chance have this up. I think this is from their Q3 earnings presentation, right? They've actually been doing like very well. Actually, is this old? This might not even be 2024. I don't think it is. Alright, forget it, just ignore that. We'll go look them up here. I'd recommend you go look at their latest earnings presentation. Wait, actually I have it here. I'll pull it up here in a second. But like, let's look at their KPIs. So it hasn't even been a year and they've already had, like what is this, 50% year over year revenue growth almost. From Q4 last year, which is always their strongest quarter. And even if you go back into 2023, like you can see they were having 20% revenue growth quarter over quarter. You always have revenue decline from Q4 to Q1 in most retail businesses. It's super normal. And I would not be surprised to see 20% revenue growth quarter over quarter, like 80 million for Q4 here. I mean, I'd almost kind of expect it just because that's kind of how the business has been going for them. And then if we look at profitability, they did recognize some tax deferred assets, so it's not like they actually had like 29 million in cash flow, but they have put on quite a bit of profitability. And their guidance for next year is $12 per share. So they're guiding, if it's $12 a share, right? We're a little bit over 20 times earnings. And I just want to remind everyone that this is 20 times earnings for a business that is going to, that will grow like 40 to 50% next year. So that's very strong growth. And they've been very good about meeting their guidance. So I think they have a tendency to be a little conservative in their guidance. I try not to put too much into that because even conservative guidance can be missed. Wait, this is, hold on, let me get Q3 up here. Let's just go through this really quick. The last thing I guess I'll say kind of about buy now, pay later short reports or whatever is these short report companies don't care if they're being, if the company's fraudulent, they just care that it can make them look bad. So that's kind of the most important thing, just to remember here, and also why invest in this business. And you can actually see them showing these ratings here. So this is a stellar quarter. And that's why if we go look at the stock price here, there's a reason why it ran up like 100% from here. I don't even know, basically to here within a couple days. Now, what I find very funny about this is after the short report, you basically had the opportunity to buy this company, knowing what their Q3 earnings were in retrospect, because that's what the people were paying right here before Q3 earnings, which I think is kind of funny. So that is why I bought the business when I realized the short report was, I don't know, just not, I didn't think there was much to it personally. And I've read a lot of short reports like that. And I don't care if Hindenburg research is well reputed or whatever. So I think, I'll try to make this really quick because I've already kind of said my piece, but you can see here that they have a lot of potential products in the future. So I think it's interesting. They're still launching new products. They have a new banking program, which they talk about here, which will streamline their costs, streamline the simplicity of their business, and also open up more opportunities. Let's get to their key metrics here. I think the most interesting thing is the subscriber growth. And they've been doing like 60,000 plus subscribers quarter over quarter. And they had, basically 100% year over year subscriber growth here. And what I love about the subscription business is its stable revenue. It's much more reliable, much more consistent. When you're a business like a firm, like you always need people to be buying stuff on your platform. So if people stop buying stuff through your platform, or somebody like Amazon starts to cut you out, like that's a genuine risk. This is a very competitive area. I don't know if I'm going to hold Sezzle long term, but I am going to hold them after at least Q4 earnings, where I fully expect the stock price to recover quite nicely. But in general, the subscriber growth is really interesting. We can actually see the active subscribers or consumers are, as I said, for the first time, they're actually increasing now. So they were decreasing, but of course the short report doesn't mention that. You can see the unique merchants are re-increasing again. So a lot of these metrics all went down and they started to re-accelerate this year. And everything's just basically fantastic in terms of business. As I mentioned as well, if all these loans were bad loans, we would not be seeing them indicate profits. And these are 6-week loans. So it's kind of hard for them to misconstrue it and make it look like they're losing a lot of money if they actually aren't. That's just kind of like my personal opinion and 2 cents on the business. And we can see provision for credit losses ticked up here from 2%. So, perhaps they're giving out maybe a little bit riskier loans. But if you go look at their provisioning for credit loss and what they actually write off each quarter has been pretty consistent and accurate. And this is probably why we had really strong growth last quarter as well. So as long as they are adjusting, they'll be fine here. And yeah, I think that's it. That's really all I want to cover. I do have a position. It's like a 7 or 8% of my portfolio, so it's significant enough. And yeah, that's why I bought, and that's why I don't